Hi, my name is Stephen McNamara, the founder and managing member of Horizons West Capital Partners, LLC. I want to thank you for taking the time to spend a few minutes with us today as we briefly share our views on the markets, describe how we help build all-weather income-oriented portfolios for advisors, and lastly, to highlight our latest portfolio recommendations, including specific ETF selections. If you look at the middle right-hand side of the slide, you will see our Smart Yield logo. Well, to us, Smart Yield is much more than just a logo, and it has nothing whatsoever to do with the silly and misguided debate surrounding the term smart beta, which has been so prevalent in the financial media these last few years. It is important for investors to understand that not all income is created equal, and our Smart Yield approach is how we go about selecting securities and, more importantly, building portfolios that have the potential to generate meaningful current income while still protecting the downside against unnecessary loss, which is critically important given the current bond market environment. As this is a high-level presentation, we will not cover all topics in great detail today. But for those interested in learning more, please reach out to us for a more detailed discussion. Hopefully, after the presentation today, you will have a better sense of how we work with advisors, how we manage risk, and how we are currently attempting to navigate the markets. You should have received a link to the Horizons West Financial Advisory Report for Q4 2014, which was just published to our website. You can review this report at your convenience. If you do not have this link, please contact us and we will send one out. For time purposes, we won't be doing a Q&A on today's call, but please feel free to email us at info@hwcpartners.com with any comments or questions about anything we go over today, and we will respond in short order. First, a disclaimer which we are required to highlight. Before we get started, a quick word about my firm. I started Horizons West Capital back in 2008, and we are an SEC-registered investment advisor. Our principal office is located in Newtown, Connecticut, which is approximately 75 miles northeast of New York City. Our primary focus as a firm is on serving financial advisors. The specialties of our firm include asset allocation modeling, multi-strategy, multi-asset class portfolio design, and ETF analytics. We essentially have two parts to the business: Horizons West Consulting and Horizons West Investment Management. Our consulting work is focused on providing advisors with our high-level and extremely cost-effective asset allocation modeling and ETF analytics advisory work in hard copy quarterly report format. This is what I'm going to talk about today. For those advisors seeking a more direct or investable way to access our work, we have created a series of separate account-based multi-strategy model portfolios, which now have a 6.5-year performance track record, and are available on a number of leading third-party platforms, including Placemark and Investnet. Today, I will be focusing exclusively on our financial advisor consulting business, but please note that our model portfolios are essentially based 100% upon this same work. To learn more about any of our advisory consulting services, please visit our website at www.hwcpartners.com. Very briefly, a little bit about me. I got my start in the investment advisory business back in the mid-1980s, and I have been investing client assets for a variety of institutional as well as individual investor-focused financial institutions for almost 25 years. You can see my academic credentials here in the middle of the page, as well as my professional affiliations there at the bottom. The main point here is that I have invested over and through a number of different market cycles and economic environments, utilizing a number of differing investment styles and strategies, and have come to realize through this experience that there is no one-size-fits-all approach to successful investing, which I think is a very valuable lesson, especially given today's uncertain and potentially difficult market environment. Okay, let's get started. To put everything I say today into context, which is very important, here is how we look at the art and science of investing. First, we believe strongly that all investment portfolios require the following three elements in order to be successful, not only over but also through time. These interconnected elements are in the blue picture at the left: appropriate risk assessment, informed asset allocation, And lastly, successful security selection. Yes, we do believe that security selection still matters. To us, it matters a lot, especially in an investment world where all markets don't go straight up, like the world in which we may have entered, or at the very least may be entering in the relatively near future. We use the analogy of a three-legged stool to describe our approach. If any one of the legs on a three-legged stool is out of balance with the others, then it doesn't take much of a disturbance to knock the stool over. It's the same thing with investment portfolios, in our opinion. If any one of the three portfolio elements just mentioned is not in sync with the other two, then that portfolio is likely to break down under duress, or at the very least generate disappointing results. Not necessarily losses, but results that were not according to expectations. We think far too many investors have become desensitized to risk given the strong capital market performance since the 2008-2009 financial market near meltdown, and are missing this very important point. There is a general complacency on the part of investors in this marketplace, both stock and bond investors, and that concerns us. Our advisor consulting work is based on the following. First, we have constructed three general investor risk profiles, which to us covers the vast majority of all risk-return requirement combinations for individual investors. Other firms have created a greater number of investor profiles, in some cases a lot more. But we believe that these three profiles cover the vast majority of real investors in the marketplace. To us, investors are either very conservative, dependent upon current income with a very low tolerance for risk, or are generally neutral toward risk and are willing to accept material stock and bond exposures in roughly equal proportions, or are able and willing to accept a higher level of risk and therefore are comfortable with an investment portfolio tilted predominantly toward equities. We have named these three investor profiles conservative, balanced, and progressive. It's important to note that in the process of doing this, we don't think in terms of traditional asset allocation, meaning stock and bond allocations, to be the differentiating factor between these profiles. Instead, we segment them based on embedded risk, and we define, identify, assess, and measure risk differently than others. It's our strongly held view that the era of the typical 60-40 stock-bond allocation for the average investor is dead, or at least it should be dead. And that's because the capital markets have changed so dramatically over the last several decades, with all asset classes essentially expensive at present, in our opinion, at least to some degree, given the unprecedented stimulus injected into the system over the last 5 years. And somewhat related, it is also our view that the 30-year bull market in bonds is over. And this requires a changing view of how to identify and measure risk, and more importantly, how to structure portfolios, all things being equal. Our view does not mean that we think interest rates are going up materially in the short term. In fact, we have for some time believed that the underlying economy is much weaker than headline data would suggest, and therefore that interest rates could stay low for an extended period of time in the future. Our point is that at this general yield level, most bond investors will not benefit from capital appreciation going forward in the foreseeable future. Instead, they will be lucky to earn just the coupon on their holdings. And remember, bond rates across the board are at extreme generational lows. So going forward, bonds as an asset class will not behave as they have for the better part of the last 35 years, generating meaningful income and providing risk reduction characteristics to the total portfolio. In other words, going forward, bonds will provide more risk, less reward. To begin the process of building actual portfolios, we start by assigning a proprietary risk target for our balanced target portfolio based on our proprietary risk analyses, and then scale up or down the embedded portfolio risk for the less relatively risky conservative target portfolio and the more relatively risky progressive target portfolio. We arrive at our risk assessments by attempting to gauge whether or not the current capital market environment for stocks and bonds in tandem can be considered normal. Not expensive or cheap, but normal, based on a variety of factors including history. The proxy we use for this analysis is a 50-50 blend between the stock and bond markets. For the stock market, we use the S&P 500 ETF, SPY. For the bond market, we use the Broad Bond Market ETF, AGG. And right now, the measured risk from this 50-50 blend is roughly 25 to 30% below what history suggests should be normal given current market valuations, the future earnings growth potential of corporate America, and the general condition of the global macroeconomic environment. This does not mean that the markets are 25% overvalued, not at all. But what it does suggest is that the markets are likely discounting an inordinate level of good news. And to us, this is a problem given the state of the global economy. So any unexpected, less than favorable news that comes out of the blue could likely have a disproportionately negative effect on the markets. So after we have determined what an appropriate risk target for the 50-50 stock bond blend should be, through our proprietary approach, which is beyond the scope of this presentation, and please note that this may be considerably above or below what the actual risk measurement is at any point in time, we then apply this risk target to the balanced portfolio. After we have assigned a risk target for a baseline balanced portfolio, we then scale up or down this recommended risk weighting by the amount you see here for the other two target portfolios to differentiate their respective risk-reward positioning, which is reduced by 50% for the conservative portfolio and increased by 25% for the progressive portfolio. The general way to understand our approach is to understand that risk is not necessarily good or bad. It must be understood in context. We willingly seek out underpriced risk and seek to avoid at all costs those risks where we do not believe we will be properly compensated. The kiss of death in the markets is to have meaningful exposure to assets where the assumed risk is not properly understood and therefore not properly compensated. This can happen when investors get complacent, like now, perhaps. So at present, we have adopted a less risky overall investment posture in all of our target risk profiles by adding exposure to less relatively risky asset classes and investment strategies and subtracting exposures to higher relatively risky asset classes and investment strategies. For the purposes of this discussion, we define risk as the 50-day smooth average of total portfolio volatility, which includes a number of our proprietary adjustments. This is not a forecast of future volatility, but an actual reading of historical volatility, which to us incorporates a great deal of information value as investor decisions and therefore market price movements are driven increasingly by actual market experiences and more relatively recent data. And please note, low volatility does not necessarily equate to low risk. Conversely, high volatility does not necessarily equate to high risk. All risk must be viewed and managed within the context of its existence. This is the essence to our approach. Oftentimes, unusually low levels of perceived market risk, like now perhaps, are more appropriately viewed as contrarian signals to reduce risk, given that prices are likely higher than generally appropriate. Just like unusually high levels of perceived market risk are oftentimes associated with declining and/or lower prices and could be more appropriately interpreted as signals to increase risk. Think of the embedded market risk based on our methodology that existed in the 50-50 capital market blend in the spring of 2007, which was generally much less than historically observed and appropriate, and the same embedded risk that existed 2 years later in the throes of the financial market near meltdown. The earlier lower risk period was in hindsight a great contrarian sell signal for stocks, and the extreme volatility that existed in the spring of 2009 was a great contrarian buy signal. In fact, a precursor to one of the strongest bull markets in stock market history. The point here is that risk is contextual. It often requires a counterintuitive thought process to appreciate. Our view is that both the stock and bond markets are complacent at present, lulled to sleep by the Fed. This won't last. We are preparing now for a more difficult environment going forward in all of our portfolios. Now, once the general portfolio risk parameters have been determined for each one of the target risk profiles, We then attempt to identify the most attractive asset classes and/or investment strategies and sub-strategies available for exploitation through ETFs. This is done through our asset allocation process. It is the backbone of everything we do. First, we separate the capital markets into four high-level capital allocation categories. You can see them here: alternative hedged, global hybrid, global fixed income, and global equities. Then we assign all the investment sub-strategies you see here in yellow, which are generally very recognizable, into the relevant high-level capital allocation category. The categories are mostly self-explanatory, with the possible exception of the hybrid category. Here we have included sub-strategies that can have characteristics of all the other categories at different times, meaning alternative, fixed income, or equity, depending upon the overall market environment. Things like real estate, MLPs, commodities, and gold. So in our opinion, they deserve a category of their own. Not everybody agrees with this approach, but we are comfortable with segmenting the capital markets this way. Then we utilize the Black-Litterman protocol, a highly novel approach that has been in use since the early 1990s, to estimate the prospective returns, both in an absolute as well as a relative sense, on a short, medium, and long-term basis for each one of our included investment sub-strategies. It is beyond the scope of this presentation to get too deep into the math of this process, but to all those interested in learning more, there is ample explanatory information available on the internet. For the record, we apply a number of adjustments to the Black-Litterman protocol to make it more appropriate for our internal use. Once this is done, we identify the embedded risk of each of these capital allocation investment strategy proxies. For this, we use the same 50-day historical volatility metric mentioned previously. This is not a forecast volatility measure, but an actual observable risk metric that we feel provides useful information value. Again, not everybody agrees with this approach, but it works for us. Lastly, we develop a matrix that incorporates both the calculated prospective returns derived through Black-Litterman, as well as the embedded risk measure for each of the investment sub-strategies in our working universe. We are looking for those capital allocation categories and investment sub-strategies that are currently positioned to provide the highest potential risk-adjusted future returns, which we will then use to serve as building blocks for our recommended portfolios. There you have it, how we assess our asset allocation opportunities. Pretty straightforward, but have no doubt this process is far easier to describe than it is to actually undertake. Now on to how we construct our portfolios using our asset allocation work and the smart yield process. But first, a little bit about our portfolio construction philosophy, which to us is the key differentiation point between our advisory work and others. We have adopted a core satellite portfolio construction methodology when building our multi-asset class, multi-style investment portfolios. But we take it a step further. Here is how we do it. First, if you look at the chart on the left-hand side of the slide, you will see our general core satellite portfolio breakdown. We generally allocate 75% of portfolio assets to our core, a more strategic, more thematic portfolio element, and 25% to our satellite, a more tactical and shorter-term focused portfolio element. This allows us to be not only consistent in our longer-term portfolio positioning, but also flexible and timely when there are appropriate tactical opportunities available in the marketplace. Now take a look at the chart on the right-hand side of the slide. Here we take the concept of core satellite a step further, beyond what is typical, which is the key to our differentiation. As you can see, we allocate a target weighting to each one of the four high-level capital allocation strategies to make up our core portfolio. 25% to alternatives, 20% to hybrids, 15% to global fixed income, and 15% to global equities. The remaining 25%, the satellite, can be allocated to any or all of the four core allocation strategies in the most appropriate fashion depending on relative attractiveness. Or the satellite can remain wholly or partly in cash, if in our opinion there are limited excess return opportunities to exploit that fall within our allowable risk parameters. We think it is dangerous to be tactical for the simple sake of being tactical alone, which is unlike how a lot of other investment managers operate, especially when the market is not providing acceptable opportunities. 100% risk on or off strategies can work very well at times, but when they are wrong, they tend to blow up. We want nothing whatsoever to do with a 100% risk on or 100% risk off strategy. We think they are inherently dangerous and should be avoided by most investors. Based on the current market environment, in our opinion, and the recent material market gyrations we have seen, expect to see some blowups in the highly tactical investment shops in the near future. Our approach is unique. The way we structure portfolios allows us to adopt a self-imposed way to apply the brakes, so to speak, when the markets appear to be overvalued and or overly risky, or both, like now, in our opinion. So our approach provides flexibility to adjust exposures if necessary. This is in direct comparison to most other multi-asset or core satellite type funds or strategies, which are often subject to strict, dogmatic, or overly static constraints regarding their portfolio construction. Okay, here is the recommended portfolio weighting for our conservative target risk profile at September 30th, 2014. 17.5% allocated to alternative hybrid strategies, 72.5% dedicated to global fixed income, 5% to global equity, and 5% to cash. The current risk posture of this profile has been reduced twice in the last 3 months, which for us is a significant move, and has been running below normal for the entirety of 2014. We have been reducing fixed income durations, improving asset quality, and have been targeting particular fixed income niches as opposed to broader market indices for the better part of the past 12 months. For illustrative purposes only, this portfolio construction is currently designed for investors seeking a 4% current yield with an annual total return requirement of between 4 and 6%, with well below market expected volatility. For the balanced target risk profile, we are recommending a weighting of 12.5% in alternative hybrid strategies, 62.5% dedicated to global fixed income, 20% to global equity, and 5% to cash. We have also been running this portfolio well below historical risk for the bulk of the last 12 months, and have also incrementally reduced the portfolio risk exposure twice in the last 3 months. For illustrative purposes only, this portfolio construction is currently designed for investors seeking a 4.5% current yield with an annual total return requirement of between 6 and 9%, with well below market volatility. Lastly, for the progressive target risk profile, we are recommending a weighting of 30% in alternative hybrid strategies, 40% in global fixed income, 25% in global equities, and 5% in cash. All the previous comments about risk reduction apply to this target risk profile as well. In short, we have been reducing risk all year in all of our work, as it is our view that most current capital market prices are not supported by underlying fundamentals, especially when analyzed through the prism of risk-adjusted potential returns going forward. For illustrative purposes only, this portfolio construction is currently designed for investors seeking a 5% current yield with an annual total return requirement of between 9 and 12%, with well below market volatility. So now that our thematic portfolio framework is finished, we then go on the lookout for the most attractive individual ETFs within each one of our most favored sub-strategies to populate our specific portfolio recommended exposures. Sadly, in our opinion, most available ETF research is performed in a vacuum and is cookie cutter at best and misguided at worst. We will leave the argument to others as to whether or not passive investing is better than active, and or whether or not strategic investing is better than tactical. To us, this argument is a waste of time, and it misses the most critical point of all. Low-cost passive exposure to an overpriced asset is still exposure to an overpriced asset, and it should be avoided at all costs, regardless of whether it is active, passive, strategic, or tactical. I don't see many others saying this in the financial media. What I do see is a lot of industry leaders stating unequivocally that all that is required for long-term investment success in all circumstances is for investors to own a collection of passively constructed, index-oriented, low-cost ETF securities. My guess is that far too many of these industry opinion makers are mistaking brains for bull markets. And history has shown repeatedly that this silly disregard for risk has always resulted in highly damaging, very material portfolio losses on the part of investors who thought they had the game figured out and therefore let down their guard. Our work is different. We perform ETF securities analyses in four main areas. You see them here: holdings-based, returns-based, valuation-based, and finally, a series of qualitative analyses. It's a fully integrated security analysis and selection process, but we do it from a portfolio perspective, as opposed to looking at a security as a standalone entity. All selected securities must add something meaningful to the portfolios, functioning as current income generators, total return enhancers, risk reducers, and/or a combination of all three. And this contribution is not always easily identified and may at times appear to be counterintuitive at first glance. So, our ETF recommendations, which we will go over in a moment, are not general in nature and should not be viewed as blanket recommendations in all circumstances and/or market environments for all investors. We are attracted to these included securities at present in very specific ways for very specific portfolio purposes, which other investors may not share. These securities recommendations will also certainly change in the future, depending on the market environment then existing. Please keep this in mind when I go over the list. Also, specific weightings for each of the recommended securities in each of the target risk portfolios are not included here. Please contact us for more information about the specific weightings assigned to each one of our recommended securities. We don't talk publicly about everything we do in this area as we apply proprietary approaches to our security selection efforts. You can see some of the analytical metrics we incorporate into our work. These analyses include multi-factor risk exposure, multi-factor performance attribution, security excess return potential, security dividend capture potential, and also the timeliness and relevance of the underlying ETF investment strategy. Generally speaking, the most important valuation metric in our security selection process is risk-adjusted relative yield, which gives us an opportunity to identify ETF securities that currently possess undervalued excess current income potential and, therefore, the potential to concurrently generate relatively lower risk capital appreciation over time to go along with the above market current income. You can see the restrictions for inclusion in our general ETF universe at the bottom. A minimum of $50 million market cap, no ETNs, no leverage, and inverse ETFs allowable in special circumstances only. Okay, now for the good stuff. Here are our top 10 current ETF recommendations in the global alternative hybrid category as we define it. They are included in the hard copy report, which you should have a link to, but I will list them here individually. For a more advanced discussion about how or why we arrived at these recommendations, please contact us to set up a private discussion. First, the Guggenheim Multi-Asset Income ETF, symbol CVY. The Spider Barclays Convertible Securities ETF, symbol CWB. The Greenhaven Continuous Commodity ETF, symbol GCC. The Spider Gold Shares ETF, symbol GLD. The iShares International Developed Real Estate ETF, symbol IFGL. The PowerShares CEF Income Composite ETF, symbol PCEF. The ProShares RAFI Long Short ETF, symbol RALS. The Vanguard REIT ETF, symbol VNQ. The Yorkville High Income MLP ETF, symbol YMLP. And lastly, the Yield Shares High Income ETF, symbol YYY. And now the top 10 current recommendations in the global fixed income category. The PowerShares Senior Loan ETF, symbol BKLN. The iShares Intermediate Credit Bond ETF, symbol CIU. The iShares 1 to 3 year Credit Bond ETF, symbol CSJ. The Wisdom Tree Emerging Markets Local Debt ETF, symbol ELD. The Market Vectors High Yield Municipal ETF, symbol HYD. The Paritas High Yield ETF, symbol HYLD. The First Trust High Yield Long Short ETF, symbol HYLS. The Spider Blackstone GSO Senior Loan ETF, symbol SRLN. The Vanguard Short Term Corporate Bond ETF, symbol VCSH. And lastly, the Spider DB International Government Inflation Protected Bond ETF, symbol WIP. Here are the top 10 recommendations in the global equity category. The Wisdom Tree Emerging Markets Equity Income ETF, symbol DEM. The iShares Select Dividend ETF, symbol DVY. The First Trust Dow Jones Global Select Dividend ETF, symbol FGD. The iShares Core High Dividend ETF, symbol HDV. The ALPS International Sector Dividend Dogs ETF, symbol IDOG. The iShares International Select Dividend ETF, symbol IDV. The iShares Global Infrastructure ETF, symbol IGF. The PowerShares International Dividend Achievers ETF, symbol PID. The Global X Super Dividend ETF, symbol SDIV. And lastly, the Vanguard High Dividend Yield ETF, symbol VYM. And now something new for us, a list of our favorite emerging ETFs, which to us means that they must have no more than $50 million in AUM. The Market Vectors BDC Income ETF, symbol BIZD. The Guggenheim Canadian Energy Income ETF, symbol ENY. The Guggenheim International Multi-Asset Income ETF, symbol HGI. The PowerShares S&P Small Cap Utilities Portfolio ETF, symbol PSCU. And lastly, the Yorkville High Income Infrastructure MLP ETF, symbol YMLI. Again, reach out to us at any of our contact points to learn more about our recommendations and how or why we are using them. Now for something that is overlooked far too often with potentially disastrous results. How do the portfolios get rebalanced? Doing this improperly can destroy an incredible amount of portfolio value. So to us, it is a critically important step in the overall portfolio management process. We rebalance each of our portfolio components according to a very specific rationale. This rebalancing generally takes place on a quarterly basis, but rebalancing may occur at our discretion in response to excess portfolio drift and or volatility. The portfolio components are on the left, and the rebalancing rationale is listed on the right, in order. The strategic core alternative hybrid components are generally rebalanced for risk management, income generation, and or total return purposes. The strategic fixed income component is generally rebalanced for income generation and or risk management purposes. The strategic core equity component is generally rebalanced for income and or total return purposes. And lastly, the tactical satellite component is generally rebalanced for risk management, income generation, and or total return purposes. To wrap things up, we are often asked by advisors to highlight the true value proposition of the Horizons West Capital approach to building portfolios. Well, before the lawyers got a hold of this slide, it was pretty straightforward and easily explained. Let me summarize in plain English if I can. Relative to bonds, the Horizons West Capital portfolios are designed to provide higher current income potential and much higher total return potential at comparable risk levels than other general fixed income oriented investment strategies. Relative to stocks, the Horizons West Capital portfolios are designed to provide higher current income potential and comparable long-term total return potential, and here I do need to stress long-term, at much lower risk levels than other general equity-oriented investment strategies. We obviously can't promise any level of future performance, but since inception of these portfolios on December 31st, 2007, through this last quarter end, the portfolios have all performed according to plan. Another page of disclaimers which I'm required to show. And that's it. So there you have it. Our approach to building portfolios. One of the ways that Horizons West Capital Partners is currently working with advisors. I hope this presentation has been helpful. If you have any questions or would like additional information about any of the topics discussed today, our investable model portfolios, or our advisor consulting services, please visit our website at www.hwcpartners.com or give us a call on 203-763-4024. Thank you very much for your time. Have a nice remainder to your day.